preparing yourself and always recognizing that if you're building your portfolio based on A, cash flow, and B, most importantly, understanding what your greatest returns are, then likely right now you're rehabbing units and making sure that you get your best rents if you've done your rent box and you understand exactly what best rents are in the market. There's nothing wrong with doing the strategy that you make the most money doing, even when it's not necessarily buying the next asset.
Redfin is out highlighting that we have more sellers than buyers. We have had many crash bros jump on this theme that the crash has started. So I want to set the stage for the fact that the three amigos for this particular episode, we are going to believe with every fiber of our body that a 20% housing crash is going to occur over the next 18 months. We are not going to split hairs. We are going to say that the U.S. housing market collapses 20% in the next 18 months. But here's the twist. What are we doing today, if anything, to take advantage of this belief that a housing crash has started and it will go down, down, down? Dion, we always go in the order that people jumped on. You were first today. What are your thoughts? 20% housing crash. What are you doing? Are you just going to Thailand and chilling for 18 months and you'll come back and figuring out then?
Well, I love the idea for the video because I guarantee that by now there's already somebody in the comments that is, calling us doomers and saying, no, you're just calling for a crash. We've called 19 of the last 2 crashes. And they don't understand quite yet the game theory, the idea that we're doing this like that Socratic method of debate. We have to explain the other person's point of view to the point where they're happy, and then we can debate. So if there was a crash bro on the other side, I would say, okay, we're buying in for the purpose of this video that there will be a 20% crash in the next 18 months, even though the largest crash in any 12-month period was 8.9%. Yep. None of the indicators are there for a crash, but we're going to say there is a crash.
Correct.
And a lot of the people, like I think you said, are going to sit on the sidelines and say, well, when the crash happens, I'll buy. And in reality, I think those people will go, okay, if the crash happened, lenders will disappear and then they can't buy. But here's what I'm doing today, right now. If I had a literal crystal ball, can go 18 months in the future, and I saw prices were 20% less, I'm buying a property today. Like I'm making offers. When it becomes so hard to buy a house that prices drop 20%, it's going to increase demand on rentals. Just like in 2009, 10, and 11, Class C rental demand went up, rents increased. So I want to be positioned for that. I would track rents on a basically weekly basis, have my binder strategies ready for my existing tenants as rents skyrocketed when home prices came down. I would hope for some tenant turnover, where some tenants maybe purchased a house as prices came down. I don't think they will. I've been trying to talk them into it for a decade. But tenant turnover also makes my rents go up because, the binder strategy gets an increase, but a tenant turnover gets you to market rents. And that's always a bigger increase in my experience. So if I absolutely knew that the crash was coming, I quote him often. Warren Buffett says if he knew what interest rates were going to be in 2 years, he wouldn't change his investing. But if I knew interest rates were going up or down, I would do the same thing I was looking for. I'd look for a deal at cash flow day one, buy it, hold it long term. But if I knew a crash was coming, I wish I bought a property in 2007 or 2008. Imagine where you'd be today. Imagine where you'd have been by 2013 after 4 years of rent increases. Yeah, you could have bought more on the way down. Maybe you will. But I want to own the asset where the rents go up after I purchase it.
I like it. Matt, you and I were both investing through the last crash. You were I'll say struggling, right? You went from having 8 paying tenants to 3 to 1. So it was really much survive at that time. But let's fast forward. You are clearly not in that situation today. Your debt financing is locked in. It doesn't matter what happens to values. I'm really curious. If you believed in your little buy box, your area, that prices were going to fall 20% residential, what would you be doing today?
So I do believe we are going to get a correction. I think that we're going to get a 10 to 20% correction. What I've been doing to prepare for that is mainly 3 main areas. And the first one is a upgrading and updating existing units when somebody leaves to make sure that we can get optimal rents. There's nothing worse than trying to get, a market rent or a higher market rent when it's a bad economy and the product is in bad condition. I'm going to get the best tenants because I have the best product that they can afford. I'm the best value in the market. So I have a really nice unit that's not as nice as a Class A, but I'm also 25% less expensive so they can afford me and they're going to be able to pay their rent. So that's the first thing. Second thing is we do things with an understanding that we still are buying deals now. We haven't pushed off the buying of anything because when the market goes down like that, there's the opportunity to then recast the debt and refi. So our focus is buying the right asset with numbers that make sense now. And then that still in a year and a half from now, even if they're down 20%, the idea is I'm not trying to sell. The idea is that I'm trying to buy into an asset that gives me good cash flow. So if it gives me good cash flow now at 7, it's going to give me amazing cash flow at 5 because when the market goes down, the rates go down as well because they're trying to stimulate things. So I'll pick up an extra 2 percentage points and all of my properties will make a lot more money on the stuff that isn't fixed rate debt. And then the last thing that I do is I'm always looking for what my best return on my capital is. My best return on my capital for the last 2 years has not been buying deals. It's been rehabbing units and vastly increasing rents. Yep. So that will likely shift in the next 18 months, where I believe that we will see some down prices. We're seeing it now. We're seeing wish pricing. We're seeing stuff sit on market. However, we're still breaking records on small multifamily. 2, 3s, and 4s are still breaking records. I think that people are banking on the rent appreciation that they're not going to see over the next 2 to 5 years. I think that rents are going to be flat. They might even adjust downward a little bit and then pop back up, based on inventory and local markets. But that was one of the main arguments that I had with one of the crash bros is he said, hey, if you look at all those estimates across the board, yeah, they're all wildly inaccurate, but it gives you a general idea. And I was like, a general idea of what? It's inaccurate. It's a wrong number accumulated over across the country still gives you a wrong number, dummy. And so what people need to look at as they're assessing their markets is those same estimates are what got Zillow in trouble and had them abandon that part of their business, which was buying and selling. So the crash idiot might want to look at that. But the second thing, most importantly, what we can do in our positions is by knowing our local market, knowing the buy box and understanding their rent box. Hey, if you know how to get your top rents with the binder strategy, you're setting yourself up for a win. If you know what your rent box is, knowing what all the market rents are in your area for that type of an asset, it's a win. If you know what your buy box is, then you can actually be gauging that and looking at deals increase over time and watching that margin improve.
Yeah, there's so much in this. I just want to summarize what I've heard from you guys so far and go to the next level because I think there's even more to get to. So the first thing both of you guys have looked at is you're looking at your existing portfolios, right? We're fortunate enough, all three of us, to have portfolios that pay for our life. But you're absolutely right. The first thing to do is take care of what you got. That's both in quality, all of you've talked about, upgrading, tenant management, rents, all of the, making sure you're getting the right rents with the binder strategy, your rent box, all that stuff. Second, financing, right? Not only have we all purposely set up our existing finance with 30-year fixed rate debt where we can, we're also realizing that, I love how you pointed at this, is I don't think a lot of people understand the chessboard. Again, in this theory, we're saying prices are down 20%. Guess what happens next? Right? The Fed and the government jump in with both freaking feet to try to save this, right? Because again, when you look at the net worth of Americans and you look at all, they can't have the housing market go down 20% and then 25 and then 30. It's like not going to happen. They will do everything they can, from lowering rates to forbearance to, all of this helicopter money, all of it. So again, we could go back and look at our debt structures. But I think the most important thing, and this is why I think the crash bros are doing their public dirty, is you got to be active today. I'm not saying buy. I'm saying be active. Right? You got to look at the buy box, right? Because again, every market is different. Sure, the country might go down 20%, but guess what that means? Some will go down 40 and some will go down 10. You got to know your buy box. And the most important thing I want people to believe that neither one of you've said, but I think you both hinted at, is I would be writing offers today. right? If I knew my market was going down 20%, I would write offers today where I'm 25% below. Why? Because I have been here before.
Mm-hmm.
I know what it's like to buy on the down cycle while everybody is scared. And then guess what? 18 months from now, when people are screaming in the Wall Street Journal and Yahoo Finance and Bloomberg that, you know, the market is baselining or flat, all of the demand comes off the sidelines because most people are scared and doing nothing. I don't want to buy then. I want to buy when there's no fucking competition, right? And to Dion's point, I want to buy with 7% rates. So that when they go to 5, I just do a simple rate and term refi, and I'm gravy. I'm groovy. So
correct.
That is the biggest thing. So Dion, am I clear? You would be very active today?
Yeah, I mean, if I knew, I would change. I would be more active than I am if I knew the crash was coming. I would be more active than I am if I suspected a crash was coming. Agreed. I think here's the one thing I know that I would do if an actual crash happens and we're 20% down 18 months from now. This is the one thing I would do that no crash bro has ever done. I would tell them they were right.
Yes, I would admit I was wrong. I mean, absolutely. Yeah,
we're talking 15 years now. No crash bro came out after 2013 and said, hey, you were right. Prices being above 2008 didn't cause a crash. In 2015, no crash bro came out and said the silver tsunami still hasn't happened a decade later. 2018, no crash bro came out and said interest rates above 6% didn't cause a crash. They didn't come out in 2020 and say a pandemic, an eviction moratorium, or forbearance caused a crash. They didn't come out in 2021 and say forbearance ending caused a crash. They didn't come out in 2023 and say interest rates tripling didn't cause that 1% increase to cause a 10% decrease that we talked about for the last year. They've never once come out and said, okay, we were wrong. There wasn't a crash. Every single time they just go to, here's the new shiny object that says a crash is coming, and this time it's different.
Yeah. I love that. Again, yeah, I would be wearing that shirt you both know I have called the swing and a miss shirt. I what people don't realize is you learn more when you're wrong than when you're right. So I would definitely be wearing that shirt. And it's real. Here's the funniest thing of all, if that ever happened, is the three of us would be more active than we've been in the last decade. We would buy more assets. We would add more cash flow. Our net worths would go up over time. And most of the crash bros would be doing nothing still, because what I saw last time with what crash bros and doomers is prices go down 20%. Guess what they're going to say? Don't catch the falling knife. It's going to be 25. Sure. It's going to be 30. It's going to be 30. They'll do nothing and they will miss it again. Matt, what do you think of all this?
I mean, I think that the crash bros are bigger gamblers than anybody is because they're always trying to time markets. Fact of the matter is that that's the loser's lament. You and I watch CNBC. I watch CNBC every single morning. It's on. Joe Kern and Becky Quick, they're on every morning. And sadly, Andrew Ross Sorkin. But they are on every single morning in my house. And so I'm listening to all of these people come on, and there's usually 6 to 8 guests every single morning. And they sit there and they opine about what their theory is and what's going to happen with the world. And how many of them are right? If you add cumulatively, you're talking about there's 40 of them a week, and then there's 52 weeks in a year. So there's 200 of them in the year. And how many are going to be right? 10. Maybe 15.
Yeah,
maybe
I don't 20. Know. Yeah, you know, I'll give them 10%. So I'll say 25. Okay. Yeah,
okay.
You know, whatever.
So 20.
But not a good batting average.
Right. So my point in that is that you've got 10% that are going to be right, 90% that are going to be wrong. And meanwhile, the only thing that really matters is that 90% of them are wrong based on the time horizon for their data.
Correct.
And so if you tweak the time horizon, which is what Dion's always talking about and saying 10 years, and what you're always talking about and saying 10 years, when you look at the time horizon being 10 years, all of a sudden 90% of them being wrong, usually about 80% of them will be right. So basically what that tells you is you just can't be a crash bro. And what you really need to do is understand that any data that you're taking in is meant to create the waves and the charts of understanding kind of generally speaking where things are. But at the end of the day, drink Dion, at the end of the day, the opportunity that this gives people is the understanding that it's a time horizon game. And so if you invest based on like you're going to be investing and living in 5 years or 10 years or 15 years, then there's really no wrong time to get in the game, so long as you are not doing something stupid like an appreciation play, and you are doing something that cash flows or is near cash flow day one. And when I say near cash flow, it's the example that Dion brought up last week, which is if you buy a deal, but you know you've got some vacant units and you're going to get people in there at current market rents, it's going to be making money in 90 days. If you know that deal's making money in 90 or 180 days, then this is not even a conversation. I'll win every single time and twice on Sundays.
Yeah, the last thing I'll talk about, if again I believed a 20% crash was coming, I don't know if I would do this, but I want to put it on record because if I was still in growth mode, you can guarantee I would do this, is I would ramp up my direct mail marketing. I would do NODs, notice of defaults. I would ramp up my marketing to FHA investors who are in trouble. Because again, I think one of the things that will happen in a 20% crash is you'll see some people give up. And I will go direct to owner and see if there's opportunities to get a deal ahead of a time, save a foreclosure, do a lease back. I mean, there's all kinds of things you could do in that environment. And, it wouldn't take a lot, right? You could use, Property Radar or whatnot to pull lists. And I might drop $1,000 a month on very focused sniper mailing campaigns. And again, we talked to Jason Pritchard and all these other guys on the channel that do that all the time. That might be something I would do if I was still in growth mode. I don't know if I would do it today, maybe. But again, your buying options go up. The other thing I did last time in this environment is I actually bought stuff. I bought something on auction.com of all places. One of the best duplexes I bought was on auction.com. So again, you got to realize that if this is happening, opportunities will be in lots of places.
Yeah.
So I would open my, I guess it's called your aperture, right? Open that up and look for opportunities in more places. Dion, let's wrap this up. And where can people find you?
You can find me right here on YouTube, Dion Talk Financial Freedom, where I do a live stream every Tuesday that lasts as long as the questions do at 4 p.m. And you point out something that would shift in my strategies is for the last decade, I've had 3 instant dequalifiers for my real estate search. I would probably remove 2 of them. So currently I've got a lot of wants and I've got some things that will eventually make me not want it. Like if there's no washer dryer, no parking, it's next to something loud, like I can eliminate a property, even if the math was good. But I have in my searches with my agents, no HOAs. I won't buy a rental on an HOA no matter what the situation is. No short sales and no foreclosures, because in the current market, you tie up money or your mental resources for up to 1.5 to 2 years. If all of a sudden the crash to 20% was happening and those increased, it'd be more like 2010 and 11 where, I'd probably look at those because banks are trying to get it off their books.
Absolutely. Love that. Matt, closing thoughts on where they can find you?
You can find me Lumberjack Landlord Thursday nights, 9 p.m. Excited to be back home on my channel, not in the Raging Tomato, having arguments with soy boys that will never do anything in their lives. So excited for that. Excited to spend time with the community. But I think so. To Dion's point, I mean, the key to buying foreclosure is actually making sure it's an REO, that the bank has taken it back, that they actually own it. Because if it's anything less than that, don't bother. It's a waste of time. Now, you can hang in the game. To Dion's point, you can hang in the game for a year and a half, and that's fine. But once it's an REO, then you're pretty safe. And at that point, it is an asset that they do want to try and get rid of, so long as they don't take too much big of a bath on it. But that said, preparing yourself and always recognizing that if you're building your portfolio based on A, cash flow, and B, most importantly, understanding what your greatest returns are, then likely right now you're rehabbing units and making sure that you get your best rents if you've done your rent box and you understand exactly what best rents are in the market. There's nothing wrong with doing the strategy that you make the most money doing, even when it's not necessarily buying the next asset. But always be doing your homework every single day, daily discipline like Mike talks about, because that's where you're going to find the diamond in the rough. That's how it always works. And to Mike's point also, expand your aperture. You need to make sure that you're getting deals and you're talking to as many people as you possibly can. Existing landlords. I actually went and hung out in landlord tenant court yesterday. I actually had 2 conversations with landlords. Listen, I'll go anywhere. I'll do anything.
I guess so.
I'll do anything short of illegal. But I was actually in court yesterday doing a workout with a tenant. And went there and actually had 2 conversations with the landlords. And I just said, maybe it's not, now's not the right time, but whenever it is, just give me a quick call.
Yeah, love that. Love that. Folks, at the end of the day, I run a school community called One Rental at a Time. I'm now convinced it's where wealth builders go to grow and network. Again, if you are building wealth, getting started in the first 5 years of Suck, one of the best things you could do is get around other people that are doing it. These two fine gentlemen went for 2 hours last Sunday. That video is in there. This weekend, we got Mr. Dan Bird coming on for a couple hours talking about stocks and ETFs and economy and all of that good stuff. We're always looking to grow and network. If you want to be around 400 other people like these two fine gentlemen, sign up for school. It is 67 pennies a day. It is crazy value. Thanks, guys. Take care.
Thanks, Mike.
Yeah.